Welcome, everyone. We're so glad you can join us for this on-demand mid-year investor update webinar hosted by JFL Total Wealth Management. Over the next 20 minutes, we will review how the reopening of the U.S. economy is affecting the markets, inflation, and interest rates, as well as what investors can expect in the coming months. Our panelists today are Jeannie Kane, who has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 24 years, working in the financial industry for more than 30. Welcome. Jerry, you want to get us started?
I will get us started. Thanks everybody for taking out some time to listen to us today. I want to talk about a couple of things in our economic update. Number one, what's happening out there in the stock market. Second, what's happening with inflation. We've had a lot of questions on that. A lot of this is really dealing with supply chain issues that we're going to discuss and take a look at interest rates. And at the end, we're going to give you an idea of what we feel is happening going into the market through the rest of the year. So first of all, where are we now? If we take a look at a global basis, what we're seeing is that there are supply chain bottlenecks where stuff just can't get through. You know, it's amazing how a factory in Indonesia could have an impact on the car business or on different types of things that are out there. But if one part of the chain is broken, it impacts everything, and also the impact of COVID-19. Secondly, if we take a look specifically in the United States, you see a huge surge in demand. People want to go out, they want to go to the beach, they want to have fun, they want to buy cars. And because of the supply chain issues, we're seeing some increase in demand, but the supply is not there. And there's also concerns about the Delta virus that's coming back and making sure that it's not having the impact that we had with the first wave. Then if we take a look at inflation, because of these supply chain issues, we're seeing increases in costs. It's the basic economic philosophy of supply and demand. The demand is huge and we don't have the supply because people can't get their products developed. And with you're going to see some spikes in pricing because of that. The labor market, there's been a huge displacement of people who are getting into new businesses. They might have been in the hospitality business before, which got decimated. They may be saying, you know what, I got to try something new. So there's a demand for employees, and a lot of people are not available. So we're seeing potentially spikes in wages because you need higher wages to attract the new labor. And then finally, when we take a look at it, what's companies going to do beyond 2021 to prepare for these types of things, which will probably occur every few years based on what's happening out there. I think a lot of businesses over the last 12 months have radically changed how they work, and you're going to continue to see those types of changes going forward. So now this is the market over the past year. The S&P 500 is up about 18%, and people take a look at January 1st and they take a look at now and they say it's 18. During that period of time, we've had tremendous volatility, and I think that's going to continue for a variety of different reasons. Number one, supply chain. Number two, inflation. Number three, not enough employees. As this stuff kind of settles out, I think we're going to have some continued growth throughout the rest of the year, but there's still going to be a lot of volatility that's out there. Now, if you take a look at a one-year period of time in the stock market did tremendous over a 12-month period. U.S. stock market's up over 44%. Really, every area. The only negative we have is on some of the U.S. bonds, and that's due to the volatility and some of the rise in the interest rates. If we go out 5 years or 10 years, we're seeing a trend. Over a period of time, the stock market goes up. When there's times of volatility, those are great times for anybody who's investing to be putting their money in on a systematic basis, such as in a 401k plan. Over a period of time, it's going to go in the right direction. But what we're seeing here is that the market's doing pretty well. Now I'm going to turn it over to Jeannie. Jeannie, why don't you talk a little bit about interest rates and what's happening out there?
Great, thanks, Jerry. So with the economy opening back up, we've been hearing more about the two I words, inflation and interest rates. You know, inflation occurs when the price of goods and services increase over a period of time. The prices go up, your dollars buy fewer of those same goods and services. This reduces your purchasing power. Now, monetary economists believe that the most significant factor influencing inflation is how fast the money supply grows. They feel that during times of inflation, the federal government should raise interest rates, which is going to slow down the money supply. Higher interest rates make it more expensive to borrow. And if it's more expensive to borrow, there'll be fewer borrowers, thereby reducing the money supply. And if there's less money out there in the economy, that puts downward pressure on inflation. So let's take a look at this in terms of a simple thing, a cup of coffee. Say you're someone who goes out and buys a cup of coffee every single day. In 1970, you could buy an entire week's worth of coffee for a little bit more than what you could pay for a cup of coffee in 2020. So consumers and investors really need to watch inflation, because those rising costs of goods and services over a period of time, that's going to decrease your purchasing power of your money. Now let's take a look at what's happened kind of more recently. The Consumer Price Index, you probably heard of that before. That's the most widely used measurement of inflation. And this index looks at changes in prices over time that consumers pay for a specific basket of goods and services. And when the June numbers came out, that number had grown to 4.2%. And that's the highest level that it's been since 2008. But to put that 4.2% in perspective, the average inflation since 1927 through to 2020, the average has only been 2.68%. If we look at the chart in front of you, the green lines represent the the years where inflation was below average, and those blue lines represent where it was above average. Now, for the past 20 years, we've been at or below average for almost all of those years, and we've been under 2% for the past decade. And we're nowhere near the peaks and the high highs of inflation or the low lows of negative inflation, also known as deflation. Those lowest levels of deflation were around the time of the Great Depression. And the peaks in those high inflationary times, those happened post-World War II, and also again right around the 1980 recession, when gas prices had a huge impact on the economy and inflation. So why has inflation been so low? Well, there's more global competition, there's more price transparency, and there've been a lot of technological improvements. So a little inflation, that's not a bad thing. The Fed actually targets inflation, and they want it to be right around 2%. They see that as kind of a sweet spot between growth and pricing pressure. Now let's take a look at the impact of inflation on how it can impact your investments. And the numbers that we're going to see on the screen here, these are inflation-adjusted numbers. So when we're comparing the values of the investments on this chart, they've already taken inflation into account. So let's take a look at the value of the growth of the dollar from 1926 until 2017. That blue line in the middle, that light blue line, that represents inflation. And inflation in and of itself would mean that you'd have, for that $1, you'd need to have $14 in 2017 to buy the same products that you could buy for $1 in 1926. Now, if we compare during that same period of time of what happened with the S&P 500, dollar back in 1926, that would be worth $533 in 2017. Again, you can see, that line trends higher over a period of time, and just like Jerry showed, it has some ups and downs. Within the past year, it also has ups and downs over that period of the extended period of time, and that's really due to market volatility and the impact of inflation. And the growth is far outpaced the growth of inflation, and as well as outpaced the growth in bonds. Now let's take a look at that bond line. That's that kind of green line down near the bottom there. If you put $1 in Treasury bills back in 1926, that's now going to be worth $1.51 in inflation-adjusted numbers. Inflation took a big bite out of the return here. Now, it's important that your portfolio is diversified so that your investments can stay ahead of inflation. Now, let's take a look at kind of some of the drivers. And Jerry had mentioned supply chain issues earlier. And right now, that's really what we're seeing is having a big impact on inflation. These disruptions in the supply chain include, Jerry mentioned labor shortages. So not only is it labor shortages of folks in the US who are choosing different roles, it's globally around the world. There are many countries that still have COVID restrictions in place that are limiting the number of people who can actually go into a factory or be able to produce things. inventory practices where, manufacturers, not everybody maintains a huge warehouse with raw materials in it anymore. There are different manufacturing processes, such as just-in-time delivery, where your raw materials show up just in time for you to put them into, your car as you have it down, going down the production line. And when those products don't arrive in time, again, your manufacturing is impacted. And there's also things like transportation delays. There's a shortage of shipping containers so far this year and delays at the ports. So all of those things are making it harder to get the goods to the places where they need to be. And we're seeing this impact various industries in different ways. Jerry mentioned cars earlier. We had a huge number of people who wanted to all of a sudden leave cities, and they needed cars to drive when they were in the suburbs and the exurbs and elsewhere. And at the same time, there's been a delay in microchips in cars. So those two things combined, making it harder to find cars, and don't even try to get a deal if you can find one. And building supplies, that's another area where we saw an impact, and it seems to be settling itself out a little bit more now, but lumber prices were up over 40% over a year ago because the supplies couldn't get to the US, and we had more people looking around their houses and during the pandemic saying, I want to renovate, or I want to do something new to my house. And again, that made it much harder to be able to get the supply to meet the demand. Now, if we look at the right side of the screen, we're going to see this bar chart here. And the government put out a survey back in June, and they asked businesses, have you been impacted, with a supply chain disruption? And over 60% of all manufacturers said yes. And at least 20% of businesses in industries ranging from construction to food service to even healthcare, they've all been impacted. This is a wide-ranging issue, and it's coming at a time when our economy is starting to open back up. So it's limiting the supply when there's a higher demand, and that's resulting in the rising inflation. So let's take a little shift here. We're going to talk about interest rates now. In general, when interest rates are high, the economy slows down and inflation decreases. The flip side is true. When interest rates are low, the economy starts to grow or is growing, and inflation will increase. Now, one of the government's tools as to how to influence how the economy will either grow or slow, and the resulting change in inflation, is by raising or lowering interest rates. It's almost like driving a car. Now, if you want to slow down the economy, you raise interest rates. So when the government raises interest rates, they're effectively putting their foot on the brake. Raising interest rates is going to make it more expensive to borrow money, and when there's less money in the economy, there's less economic activity, and it's speeding up, and it lowers the risk for inflation. And the opposite's true if you want to speed up the economy. And that's exactly what the government did during the pandemic. They lowered interest rates. It became less expensive to borrow money, so more money went out into the economy, and that increases the risk of higher inflation. Now, in June, the Federal Reserve said they were going to raise their expectations for inflation and brought forward the timing of when they said they were going to raise interest rates next. And the timing, they said, could be as soon as 2023. So right now, the government set the interest rates. They're really very, very low. And these have an impact on what you can get in your money market account, as well as when you buy CDs. And in finance, we have a calculation called the Rule of 72. And this calculation helps you understand how long it will take for your money to double. So say you have your investments in a brokerage account and it returns 7.2% per year. Your money will double in 10 years. However, if you have your money only in a money market account that's paying 0.07%, and that number, just keep in mind, that's dropped by almost half since last year. This investment, this money market, it would take 1,028 years for your money to double. And if we look at a 12-month CD, that's at that 0.17% interest rate, it's going to take 420 years to double. Recall that inflation, on average over that period, that extended period of time, the average was 2.68%. And then again in June, that number jumped up to 4.2%. So if you're invested in these really conservative types of investments, you're effectively losing money. And that's because your investments aren't keeping up with inflation. And it's really important here to think about a diversified portfolio. So let's take a look here at this chart. I know there's a lot of colors, a lot of numbers that are going on here, and it actually looks quite a bit like a quilt. So each color here represents a different part of the market or a different kind of asset class. And each box has a performance number listed inside of it, and they're listed from highest at the top to lowest at the bottom. And if you look at kind of on the right side, you'll see there are various kind of asset classes. We've got real estate, commodities, various types of stocks, and different types of bonds. And what I find most interesting about this chart is if we're looking over a period of time, we're seeing that one asset class isn't always the best, it isn't always at the top, and it isn't always the worst. It's going to change from year to year. And in fact, many of the high performers one year are the lowest performers the next year. Like if we take a look at real estate in 2020, that is at the very bottom. It was down 8%. But so far, year to date, it's at the top, and has a 22% gain so far this year. This really underscores the importance and the benefit of diversification. You really don't want to put all of your eggs in one asset class basket. So I'm going to right now turn it back over to Jerry, and he's going to wrap it up.
All right, so this is my take on what's happening out there. Year to date, the stock market has done incredibly well, which makes sense. And actually, this makes sense a lot more than what the stock market did last year, especially towards the end of the year. All the major indexes are up right now. And based on everything we're seeing, we feel pretty good between now and the end of the year. This should continue. What does potentially concern me is issues with COVID and the variant that's out there. And that's going to have an impact on the supply chain that we were taking some time talking about, to the extent that people can get back to work and the systems start working better again, we should see a decrease in the pricing. Interest rates right now still are at all-time lows and very, very low. So if you want to buy a home, now's the time to do it. But probably going into 2023, the Fed has signaled that interest rates are going to start rising again, which kind of makes sense. I mean, you have to think about that. Does make sense. And then finally, inflation is moving quicker than most people had anticipated. But like we mentioned before, I think a lot of these are supply chain issues. It's supply and demand. The demand is way up here, and because of supply chain issues, we can't get the products out to the market fast enough, which is driving up the price. And I think over a period of time, it's going to be fine. But overall, I feel very good about what's happening out there. I think the market's acting reasonably based on the fact that people were locked up for a year and they want to go out and have some fun. And going into the end of this year, I think everything is going to remain relatively good. So again, I would say please get in for your meetings. If you have any questions on any of this stuff, please get back to me. Gretchen, do we need anything else here?
No, just thank you to both you and Jeannie for that great mid-year update. And hopefully you all have received a copy of the recent newsletter we have that reinforced a lot of what we discussed during today's presentation. And we'll be back with some additional webinars in the next couple months that are addressing topics such as investing in real estate, identity theft, and planning for a special needs dependent. So if anybody has any follow-up questions or would like to speak with Jeannie or Jerry about your personal financial situation, please contact our office. Thanks so much.